Have you ever stood at the edge of a dense financial forest, map in hand, yet felt the chill of uncertainty as the path ahead blurred into 1,000 confusing trails? Or perhaps you felt the unsettling churn in your stomach, trying to make profound investment decisions amidst a cacophony of conflicting voices, each promising a different, often contradictory truth. This feeling of being adrift, of grappling with an unseen current that pulls you in directions you don't understand, is a familiar companion for many on the journey to sustainable wealth. The fear of making a costly misstep, the frustration with advice that feels superficial, the quiet anxiety about future security. These are not small burdens. They are real weights upon the spirit, echoing experiences of loss, of unseen efforts, of a longing for a clear, unwavering sense of direction in a world that often feels designed to obscure it. But what if the greatest challenge lies not in the market itself, but within us? Benjamin Graham, the sagacious architect of value investing, once observed the investor's chief problem, and even his worst enemy, is likely to be himself. He wasn't speaking of external foes, but the inner turmoil, the emotional eddies that can drown even the sharpest intellect in a sea of market noise. This internal struggle, this battle against our own biases and fears, is where true financial mastery begins. It's the silent enemy that whispers doubts, that pushes us towards impulsive actions or, worse, paralyzing inaction. Many pursue wealth by chasing fleeting headlines, by reacting to every market tremor, or by clinging to the seductive whispers of intuition alone. This, however, often leads to what we call the clarity gap, a chasm between raw information and truly actionable insight. It's a path strewn with underperformance, where genuine value remains obscured by the fog of speculation. We seek not to suppress intuition, but to fortify it with robust mental models, frameworks that act as steady anchors in a volatile sea. These are not rigid dogma but flexible lenses, designed to transform complex financial data into a coherent narrative, allowing you to see the true currents beneath the surface. Today, we embark on a journey to unveil 8 such powerful frameworks. These are the very tools that can demystify the market's intricate dance, bringing a profound sense of understanding and control to your investment decisions. They represent a verifiable alternative to the fleeting trends, offering a structured, data-driven methodology that empowers you to move beyond mere reaction. We're not just offering tips, we're offering a compass forged from the wisdom of financial giants to clarify your path towards sustainable wealth and true financial independence. The first framework we must embrace is the Intrinsic Value Deep Dive. Have you ever felt that gnawing fear, the one that whispers, "Am I buying too high?" This fear often stems from a deep-seated inadequacy in valuation, a struggle to separate a company's true, enduring worth from the fleeting, often erratic, dance of its stock price. It's a painful feeling born from market volatility, a sense of being perpetually a step behind. The common distortion, the one that blinds so many, is believing that the market price asterisk is asterisk the value. We see a number flashing on a screen and conflate this transient figure with the fundamental strength of the underlying business. This is a profound confirmation bias, where the market's current mood becomes our conviction, even when contradictory evidence lies just beneath the surface. Yet, as Benjamin Graham taught us, price is what you pay, value is what you get. The market is not a perfect judge. It is often irrational in the short term, swayed by emotion and speculation, not the solid bedrock of underlying economics. This shattered expectation that market prices are often a poor reflection of reality can be unsettling, but for the true value investor, it is precisely this irrationality that offers opportunity. We do not get swept away by the market's whims, we exploit them. To unmask a company's true worth, we must become deep-sea divers, venturing beneath the surface. First, we deconstruct financial statements to understand where sustainable earnings originate. Are they real, recurrent, and robust? Second, we apply discounted cash flow, or DCF, models using realistic assumptions, not optimistic fantasies, to project future cash flows and bring them back to their present worth. And third, we compare this quantitative analysis with qualitative factors, the strength of competitive moats and the integrity of its management. This 3-step technique is a practical transformation for daily decision-making, moving you from speculation to informed conviction. While others surf the market's waves, reacting to every crest and trough, the savvy investor dives beneath the surface to discover the unshakable bedrock of intrinsic value upon which sustainable wealth is truly built. What silent fears about valuation have held your investment decisions captive? Have you ever felt that unsettling doubt, a whisper that perhaps the financial currents are always steered by unseen hands, leaving you feeling outmaneuvered in a landscape designed for a select few? This philosophical wound, this distrust in the very fairness of financial authority, can lead to a quiet resignation, a feeling that no matter how diligently you study, the smart money will always find a way to win. It's a deep ache, questioning if true financial independence is even possible amidst such perceived imbalance. The common distortion often presented is the efficient market hypothesis, or EMH. It suggests that that all available information is instantly and perfectly priced into every asset, making active management futile, rendering individual research pointless. This simplification, while elegant in theory, often ignores the vibrant, messy, and profoundly human element of the market. It's an overconfidence bias, a belief that the market is always right, which can mask a critical lack of due diligence on genuine market anomalies. This belief, however, shatters when we witness the market's wild swings, its inexplicable enthusiasms, and its sudden, crushing despairs. The counterintuitive truth, revealed by the profound insights of behavioral finance, is that markets are not perfectly rational. We, the participants, are not perfectly rational. Systematic cognitive biases, like anchoring to initial prices, succumbing to herd mentality, or the powerful grip of loss aversion, create persistent, exploitable mispricings. For the disciplined investor, these human imperfections are not obstacles, but opportunities. They are the predictable ripples in the market's surface that a keen eye can learn to navigate. To truly dissect and unpack these biases, let us consider a symbolic exercise. Reflect on historical market bubbles and crash, not as random acts of chaos, but as predictable consequences of collective emotional and cognitive errors. When have your own loss aversion tendencies, that deep human reluctance to acknowledge a mistake, perhaps clouded your judgment? Consider the profound wisdom of George Soros and his reflexivity theory. He understood that market perceptions don't just reflect fundamentals. They can actively influence them, creating powerful feedback loops that the tidy equations of efficient markets simply overlook. His story reveals the critical importance of independent thought and data-driven analysis over blind adherence to market sentiment. Have you ever questioned the underlying assumptions that shape your financial world? Have you ever known the silent fear of investing in a company that seems unshakable, only to watch it slowly, then suddenly crumble? This apprehension often stems from a lack of clarity, an inability to truly discern what protects a business from the relentless tides of competition and ensures its long-term profitability. It's a wound felt deeply when a seemingly wise investment betrays your trust, leaving you to question what truly constitutes durability in a volatile market. The common distortion we often encounter is the belief that high growth rates alone signify a great investment. This neglects the critical element of sustainability. We are often drawn to the dazzling allure of rapidly expanding companies, chasing the dopamine rush of novelty, mistaking swift expansion for enduring strength. This pursuit of the new, however, frequently leads us down paths where competitive pressures quickly erode profits, hindering truly empowered decision-making. The shattered expectation here is that economic moats are static, unmoving fortresses. The counterintuitive truth, however, is that even the strongest moats can erode or strengthen over time. A business considered durable yesterday might be vulnerable today, requiring continuous, rigorous qualitative analysis beyond simple metrics. This means we must constantly re-evaluate, understanding that the landscape shifts. To navigate this, we employ the economic moat framework, a practical transformation for discerning true strength. This involves a moat checklist, evaluating specific, tangible aspects. Are there powerful network effects that make a product indispensable? Does the company possess significant cost advantages that competitors cannot easily replicate? Are there unique intangible assets like a formidable brand or proprietary technology? And do customers face high switching costs if they try to leave? This technique, profoundly inspired by Warren Buffett's emphasis on competitive advantage, shifts our focus from fleeting short-term trends to the enduring promise of long-term durability. Consider the metaphor of the castle wall. Just as a medieval castle's moat and formidable walls protected its inhabitants from siege, a company's economic moat defends its profits and market share from competitive attacks. This protective barrier ensures its longevity, allowing its inherent value to compound steadily for discerning investors. Without such a moat, even the most promising venture can become an open field for rivals. What seemingly strong companies have you seen crumble because their protective moats were, in fact, an illusion? Have you ever felt that silent fear, the one that whispers of financial loss even when you've been told your portfolio is diversified? This feeling of vulnerability, a deep distrust of conventional financial advice that often simplifies risk to mere volatility, can leave one feeling exposed to unseen systemic shocks and the devastating prospect of principal loss. It's a wound that lingers, questioning the very foundations of security you thought you had built. The common distortion is believing that diversification alone guarantees safety, or that risk can be neatly summarized by a single metric like beta. This leads to a false sense of security, overlooking the insidious, true risk factors that lie beneath the surface. The shattered expectation is realizing that the most significant risks are often qualitative, unquantifiable by standard deviation. The counterintuitive truth is that fatal events, those rare but catastrophic occurrences, systemic risks, and the permanent loss of capital are far more damaging than temporary price fluctuations. A temporary dip can recover, a permanent loss leaves a lasting scar. To truly discern and frame these unseen threats, we must adopt a deeper three-step technique. First, stress test your portfolio against extreme but plausible scenarios. Imagine an interest rate shock or a sudden commodity collapse. How would your holdings fare? This isn't about predicting the future, but understanding resilience. Second, diligently analyze counterparty risk and liquidity. Who holds your assets, and can you access your capital when you truly need it? Third, understand the opportunity cost of capital tied to underperforming assets. What is the unseen cost of holding onto something that merely treads water when your capital could be working harder elsewhere? Consider the metaphor of the iceberg. Just as 90% of an iceberg lies hidden beneath the surface, the most dangerous risks to your investment capital are often unseen by conventional metrics. They are submerged, waiting to cause immense damage if not properly identified and mitigated through a deeper, more analytical framework. What hidden risks might be lurking beneath the surface of your own portfolio, unseen by the casual glance? There is a silent pain that many ambitious investors carry, the frustration born from an incomplete financial education, leaving them without a clear framework for how capital should be strategically deployed. This absence of a guiding hand, this uncertainty about where to direct your hard-earned resources, directly hinders the accumulation of sustainable wealth. It's a feeling of being stuck, of knowing you could do more, but not knowing the precise steps to take. The common distortion is focusing solely on generating returns without a clear, deliberate strategy for reinvestment. We often fixate on the initial gains, allowing the allure of immediate profits to overshadow the profound power of long-term strategic compounding. This cognitive and emotional bias sabotages our ability to critically analyze financial data, prioritizing the fleeting over the enduring. But the shattered expectation reveals a counterintuitive truth. Not all reinvestment is equal. Intelligent capital allocation, whether reinvesting profits directly back into the business, executing strategic share buybacks, or distributing thoughtful dividends, is a primary, often overlooked driver of long-term shareholder value. Short-term market narratives frequently miss this deeper mechanism, focusing instead on quarterly earnings reports rather than the fundamental strength of how a business nurtures and grows its capital. To master this art, we can adopt a powerful three-step strategic finance technique. First, evaluate management's track record in deploying capital, often measured by return on invested capital, or ROIC. Does leadership consistently allocate resources in ways that generate superior returns? Second, analyze the company's internal reinvestment opportunities against external alternatives. Is there a higher return potential within its own operations, or would returning capital to shareholders be more beneficial? Third, understand the tax implications of different capital deployment strategies, as these can significantly impact your net returns. Consider the enduring story of Warren Buffett's consistent emphasis on capital allocation. He reveals the critical importance of independent thought and data-driven analysis, recognizing that a CEO's primary job is not merely to run operations, but to be an astute capital allocator. This fundamental truth directly impacts the compounding power of your investment, determining whether your capital merely breathes or truly flourishes. What opportunities for exponential growth might you be missing by not deeply understanding how capital is truly allocated? We have journeyed together through the intricate landscape of investment decisions, seeking not just answers, but profound clarity. From the intrinsic bedrock of a company's true worth, unmasked beneath its fleeting price, to the subtle yet powerful currents of behavioral biases that sway market sentiment. We explored the protective walls of economic moats, discerning what truly shields a business from competition, and then dove into the unseen depths of risk beyond mere volatility to identify the threats that truly imperil your capital. Finally, we navigated the strategic currents of capital allocation, understanding how diligent reinvestment fuels exponential, sustainable growth. These frameworks are not mere academic exercises. They are your arsenal against market complexity. Warren Buffett, with his characteristic clarity, once observed, "Only when the tide goes out do you discover who's been swimming naked." This poignant truth speaks to the very essence of why these frameworks matter. In times of exuberant market highs, nearly everyone feels like an investing genius. But when the tide recedes, when the market faces its inevitable downturns, it is these robust frameworks, your carefully chosen garments, your diving gear, your compass that ensure you are not caught exposed. They provide the enduring structure, the shield of understanding that allows you to stand firm when others are swept away by panic or confusion. This journey marks a profound transformation. It is an invitation to move beyond reactive speculation, to shed the anxiety of fleeting trends, and to embrace proactive, data-driven decision-making. It is about replacing the gnawing fear of the unknown with the calm confidence of informed insight. You are not merely investing in companies, you are investing in your own capacity capacity for discernment, for critical thought, for unflinching truth. So, let this moment be a quiet commitment. Embrace the discipline inherent in these frameworks. Challenge conventional wisdom, not out of rebellion, but out of a sincere desire for deeper truth. Cultivate that profound, independent thinking that is the hallmark of true financial mastery and sustainable wealth accumulation. Allow these principles to become the very fabric of your investment philosophy, guiding your hand and steadying your heart. As you stand at the edge of your own financial future, what will you choose to build your wealth upon? The shifting sands of speculation or the enduring bedrock of data-driven understanding?